Good afternoon. Peter Klein, Chief Investment Officer, Founder, ALINE Wealth, here with you on the 29th of April, 2024, for a little update on the current market and economic conditions. I will proceed. You can watch the screen in front of you. The title of this talk tonight is The Return of the Stag. And there she is, the stag, or he is, the stag. And the thinking there is stagflation back? And we see evidence of that. And for those that are not familiar, stagflation is a term from the 70s where we had an economy that was, let's call it soft, but inflationary. The persistent, sticky inflation that we've seen since the beginning of the year, despite the expectations for for a lessening and a mitigating of inflation. It's very tough to get that inflation genie back in the bottle, folks. So we've been saying that for a few months now, and so far that's been the case. We'll see what the future brings. Okay, and that future, that new regime versus old regime is certainly part and parcel to what our thinking has been consistently for the last few months, even a year now. The wind of ultra low interest rates is no longer at our backs. We need to be more active and more engaged, understand what you own and why you own it. No longer can fiduciary-centric investment management be orchestrated passively or through simple momentum. Those days are done. It's back to good old-fashioned analysis and understanding what you own and why you own it, and portfolio management. This is not the kind of market where you just simply throw a dart against the wall. And part of that is the conditions have changed. TINA is RIP. TINA stands for there is no other alternative. There is an alternative now. It's cash and it's risk-free and it's paying 5%. So that's no longer the case. Deglobalization and near sourcing are in vogue, and those are inflationary. And labor strength is on the rise, and that certainly is also inflationary, wage inflation. We also see the decarbonization standards having an impact on green metals and materials, and that is important because they have increasing demand coming as well. So those factors lead us to believe that inflation is not going to be put to bed so quickly. The playbook: more value, fundamental analysis, more resource-based companies with pricing power, also commodities as a hedge, and cautious on bonds and high multiple stocks for the obvious reasons. This is the slide that we've been turning to for almost 4 months, 5 months now. And it shows, I think very nicely, the period post-World War II. We came out of the war, and we saved the world from fascism, and here we are in the United States, and we start fixing our economy post-war. And of course, the 50s and the early 60s, you had an explosion of consumer behavior and consumer purchasing. The interest rate on the 10-year bond was going up, and then it hit the hyperinflationary 70s and just took off. And here we are in 82 at the top, about 14, 15% interest rates in the 10-year. Over those 36 years, the S&P 500 did about 5.7% per year. The ensuing 39 years, the S&P 500 did 12%, 11.8% a year. The difference is that in the last 39 years, we've had a decreasing and ever decreasing, lower and lower and lower interest rates. And we've gone through a number of reasons why that was the case, with the globalization and the exporting of inflationary pressures and the advent of women and immigration policies, lowering the price of labor, technology being a huge disinflationary agent, and the USSR crumbling in '89, flooding the world with commodities also served as a disinflation agent. And with all that disinflation, the Fed was able to lower the price of money, ergo interest rates. And when you do that, all good things happen to paper assets, be it stocks or bonds, they go up, and they've gone up big. We believe that now there's been a turning point in 2020, and that turning point is this new regime we're speaking about. And in that new regime, we're positioned the following: overweight cash, respect volatility, use cash as markets gyrate, and remain patient for the best price levels. Wait for that fat pitch. It's coming. Fixed income is no longer the ballast it once was. We need to be cautious there. Dividend growth, value style, again, screening for high free cash flow yields. That's where we're finding most of our opportunities. Again, we talked about inflation-centric sectors, real assets, infrastructure, resource companies, companies with pricing power, and the water sector, which has been our favorite for a decade plus. The macro backdrop, simple. Debt levels are unsustainable. This is where I believe you'll see the next financial crisis. It's coming from debt. We've got too much of it. And now, as you can see here, it's becoming very expensive for us to service that debt. It used to be lower down in this level, obviously, with 1% interest rates. You could service the huge amount of debt we have. But now we're up here, and we're going higher. Because as those old bonds refinance, they're getting higher returns now. So therefore, the Treasury's got to pay higher interest rates to service them. And that's a problem. And you could see back in the, in the inflationary 70s, early 80s, this is what we had. And then, then of course, as those old bonds rolled off, interest rates were coming down. So the cost of that debt came down. And of course, you had the technology revolution in here, filling the coffers of the Treasury as well with tax money. So important stuff, this debt issue. And if you look at how it's, where it comes from, if you will, this is a great depiction from our friends at Malden Economics that shows the inflows and the outflows and the deficit of almost $1.7 trillion. None of these things are going to be cut. And then you also have to realize that net interest, which is $659 billion, is going to be a lot more, probably closer to $1 trillion next year. So, I don't see how we're going to get around this. And so this is why we're very concerned about the debt situation and the implications that has for the economy on a whole, which basically means higher for longer interest rates. We see opportunities. There are always opportunities. You got to sort of hunt them down these days. It's not as easy as it once was, and we're doing a fair amount of that hunting as we speak. So we're finding opportunities in international markets. This is a great slide. It shows you, let me walk you through it. And between 74 and 79, when you had a low in the relative valuation between IFA and the United States, right here, that circle, in the ensuing 5 years, the USA MCI USA index was up 11.7. The IFA was up 17.9. It happened again in 92 to 95, 400 basis points more in return for the IFA. Same thing in 01 to 06. Look what happened. Huge differential, 900 basis points. So when things get cheap, the next few years are strong. Same thing in the past. When things were expensive, like in the February of '89, here, the markets were expensive, the international markets relative to the US, the United States outperformed dramatically. And again in 94 to 99, and again in 09 and 19. So that's a long run. And so this is what we're seeing here now is we feel that now is a very good time as depicted in this circle in the 2020-21. We think that the international markets are positioned such that we could see a strong forward return for some time to come. They're clearly overdue. And they're trading at multiples that are low. Look here, you'll see in the box, the current PE, forward PE for Germany, UK, Spain, and Italy is much discounted from their 20-year median. 20 years. So good data point there that shows opportunities in the international markets. Looking at the internals of the markets, return to this Nifty 50. This was a term that was used in the early 70s, 50 of the stocks that were, I guess, like the Magnificent Seven of today. And as you can see back in the early 70s, those top 10 stocks represented about 34% of the S&P 500. That's where we are today. And that's comparable to where we were back in 72, 73. And look what happened after that. And so whenever you see this over concentration, you saw it here a bit too in the dot-com bubble. You see what happens to the markets afterwards. So be warned. This market is concentrated, and that is typically not a great thing. If you think you could time the market, think again. This is we always show this. This is a way to show you that by staying invested and proactively managing the edges, ergo capital allocation, you can do a lot better than this idea of being all in or all out. And here this shows you that over the 40 some odd years of data here, if you had invested in all those days, did a Rip Van Winkle, didn't touch it, you'd have grown your 10,000 to almost 1 million. But if you just took it all out and happened to miss the 5 best days, although obviously you don't know when those days are, you're down 38%. If you miss the 50 best days, depending on how long you're out, it's very possible, you're down 93%. So don't time the market. Have a core portfolio, work the edges with respect to capital allocation, which means when things are overdone to the upside and ratios are high, PE ratios are high, you want to be able to stay focused on the longer term and look to allocate slowly when things are down and it's the old story of buying low and selling high. With that, I'll say good night. I hope you're well. I'll show you the stag again, and let's hope we don't stay too much in this stag area for too long. It's not pretty. Wishing you the very best. Happy spring. Peter Klein, ALINE Wealth. Talk with you soon. Thank you.